Hello and welcome to this episode of Scientific Investor Series, the Investor Education Initiative from Omniscience Capital. And Vikas, so today let's discuss about the mystery of alpha, right? So everyone is chasing alpha in the stock market, and excess returns, alpha,
Right.
whichever way people want to look at, or the absolute returns from any portfolio. But while everyone chase that or is trying to beat the market, uh, though we have discussed earlier that that's the biggest or the first source of risk that people get into, but
Absolutely.
let's try to kind of demystify and see where that alpha is hidden and how we identify or we look at it.
Right. Right.
Yeah.
So we will not go over the other things.
Hmm.
In other videos on scientific investing framework, we have already shown how we are enhancing or chasing safety, right? Even the
Right.
Omni Insight is about chasing safety
Safety.
and getting alpha,
Right.
right? As opposed to chasing alpha and getting risk.
Getting risk. Right.
So that we have already discussed. Even the scientific investing framework, when it enhances safety by fundamental balance sheet strength,
Right.
and so on, right? Persistent competitive advantage and
Right.
all those things we have discussed earlier.
Right.
So right now we'll directly jump into demystifying where true alpha is
Correct.
coming from.
Yeah, that's I think very important to understand at this, because the moment you talk about extra return, people automatically think that there is some extra risk hidden, or you have
Absolutely.
taken some additional risk,
Right.
and because of that there is additional return. And when we talk about excess return, we have already taken care of the first reducing the risk part of the portfolio or the
Absolutely.
investing, right?
Absolutely.
So it not need not be confused with the academic or that intuitive
Right.
thinking of high risk high return. That is something doesn't work here. So
Right.
we have taken care of the risk part, lowering the risk of the portfolio or investments. Now there is absolute excess return, and where it is hidden, how we are arriving at, that's what we want
How to
to
search for
search
it.
for that, right? So yeah, go ahead. I think
So there are three elements. The way we do it, there are three elements of contributors to alpha. Right. First is the yield.
right.
Right. So if your and yield is what? So let's take the simple thing which everyone understands, which is P.
Correct.
And if you invert it, it is E by P, which is the earnings yield.
Correct.
But you don't get all the earnings. So earnings are declared and all the shareholders own the earnings, but the management decides to retain, or the board decides to retain some of it for maintenance capex and for growth capex.
Right.
And the remaining is now available for distribution as dividend, right?
Correct.
Normally this is how people view it. And in India usually this works, but because we do global portfolios and there could be a lot of non-cash accounting entries, etc., so we trust more on the free cash flow yield, right? So in Indian companies, typically the free cash flow yield and the net of capex yield,
Yeah,
which is dividend
similar.
plus actually,
Right.
that should be similar, right? So free cash flow yield, which is free cash flow divided by enterprise value,
Right.
because there is also debt in the when you're buying a company. So FCF yield. Now you want to enhance yield, right? So
Right.
suppose the market yield is let's say 5% or 4%.
Yeah.
You want companies with higher than that yield normally,
Right.
that is one part of it. And let's say you have 7% yielding portfolio, which is what, a P of or a PFCF of about 14, right? 14.
Right.
So suppose you have 7%, market has 5%, then you've got 2% alpha.
Correct.
Right? Or market has 4% yield, you have 6% yield, you have 2% alpha right there. Right. So there is some contribution from a higher yielding set of companies.
Correct.
If you create a portfolio of higher yielding. Second piece is that, let's say market growth is X% and your portfolio has 2% or 3% higher growth,
Right.
then again you have alpha, because your portfolio companies are now growing faster. So yield, growth, and the third factor is re-rating.
Right.
Okay. So if you have let's say company is growing at 15% while market has companies growing at 12%,
Right.
just as an example. Then a higher PE ratio
Right.
or a lower yield is justified
Justified.
because it's a higher growth portfolio, so
Yeah.
a lower yield is justified.
I think this is a point, to be just noted, because, like sometimes the high yield is justified because the growth outlook is low, right? Compared to
Correct.
what essentially we are talking about, that there is the real opportunity lies where the yield is low, but the growth outlook
Growth
is actually stronger, and market
Exactly.
is going wrong,
Exactly.
in that.
Exactly.
And still, like, even whatever the market estimation of growth is, and based on that, whatever the yield it is giving, effectively, market is like, keeping it cheap, mispricing it, right? So
Yeah.
so that's a combination of, yield and growth outlook that you have to look at
look for.
forward, right?
Right. So you got couple of percent
Oh,
higher on yield.
Yield.
You got couple of
Percent.
percent higher on growth. So you're
Growth.
already 4-5%
Right.
excess returns, right? And now you bring in re-rating.
Right.
So that's the third factor.
Right.
So let's say for argument's sake that growth is same.
Right.
For a
For
portfolio,
portfolio.
two portfolios. One is
Correct.
the market portfolio and one is your portfolio. You've selected something, but the yield is higher.
Right.
So yield should now go back to the market yield.
Market.
So let's say your average PE ratio, and I'm just using PE. Actually,
Right.
we mean the inverse of FCF here, right?
Right.
But I'm just calling it PE because that's what people understand. So let's say your PE is 15, market PE is 25. That's like a 60% upside.
Correct.
And let's say the growth outlook is
similar.
same,
Right.
right?
Right.
So there is a 60% upside.
Right.
Now that could take 5 years, in which case roughly 10%, 12% per annum is the extra return beyond yield plus growth.
Correct.
And the yield was already 2% higher, so you were earning 2% higher. Growth was whatever, it was the same thing. So market was going to grow at X, yours is growing at X, but you have 2% higher yield. So yield plus growth, so throughout the period you are 2% ahead of the market.
Right.
But let's say even if it takes 5 years to catch up to the market ratios, you have 10% extra return.
Right.
So you are now 12% ahead of the market.
Absolutely.
You can see how powerful this is, right?
Correct.
So this is the great thing.
Right.
Okay, and this is where you get, and if it happens earlier, let's say it happens within 3 years,
Right.
that's completely crazy, right? Now you are 20% plus kind of range, and let's say it happens in 2 years, it's a really large, right? And that becomes the main contributor.
Correct. Right.
So this is something which people miss out.
Right.
And
so this, I think this sets a good context of, how potentially, you can kind of ascertain, what kind of a potential in terms of returns you are looking at, because people get confused with, what is your target price, right?
Exactly.
And that's where, if the free cash flow yields is growing very fast, or the free cash flows are actually growing very fast, then you are looking at a moving target on the price target itself.
Correct.
So this is the equation which helps, in terms of seeing that, okay, now have I come in, similar yield to the market, similar growth outlook, no further
than a rupee
rotating
number of the target
right
price.
Right. So that is how you have to, chase this moving target of, what is your target price when you want to sell the stock.
Exactly.
The other thing I think here, which is quite relevant and we can kind of touch upon, is the growth traps, what we call it, right?
Exactly.
Like, in the same equation, if you like just ignore at some point that, okay, I don't really worry about the yield, because whether it is one half, whatever it is, because I'm focusing on growth and the growth is there,
Absolutely.
So you have already gone to the overvalued territory typically, let's say, because no company can grow for like very high growth rates at very high long periods. So there, you just like the re-rating, and spectacular returns can be seen, spectacular underperformance can be seen if you have, de-rating has happened.
Absolutely.
Right?
Absolutely.
So and people puzzle, that it is a fundamentally very good company, and why the stock is not working. Right?
Exactly. And exactly. So when you look at yield plus growth, yield looks small. right?
Right. Right.
Yield
It's
will
very
be
insignificant
4-5%,
Right.
while growth is 12%, 15%, and for high growth companies it could be 20-25%,
True.
right? And so people say, oh, forget about yield,
Right.
which is basically the value investors game,
Hmm.
and look at growth, which is the growth investors game, and
Right.
then the momentum investors game, right? And so people say this is a superior thing.
Correct.
The only problem is if the yield is really low, as in lower than 3%,
Right.
then you're getting into difficult territory, and you're probably looking at a potential derating. And we have seen that, like last 2-3 years, all the darlings of the market, those have been underperforming, right? Severely.
True.
So despite the growth and everything being there, in some cases the growth was anyway not there.
Correct.
So they were not even growth companies, but still people were paying 80p and 50p, etc.
Great. So I think this kind of framework should really help viewers of yield plus growth plus re-rating to understand where their alpha, what they are building in their investment portfolios or stocks is should help them. And this works across, like if the beauty is that whether you are viewing from a growth investor lens or a value investor lens or any other investor, you can still make sense of this framework and see that okay, where your alpha is actually going to come from.
Absolutely. And before choosing any portfolio, not just our portfolio, any portfolio, you can try to assess this.
Right.
That what is the yield of that portfolio, what is the growth of
outlook?
that portfolio, and what is the likelihood of a re-rating or a de-rating.
Right.
And if you do this right, then you will be able to select not for past performance, but select for prospective performance, which is what you want when you are investing. Past performance is not going to be repeated, right? That's a big disclaimer by all the regulators everywhere. Everyone understands. So you are actually trying to select for the prospective returns, and this helps you ascertain that. Of course, you can't put a number that what is the precise number. Yeah.
Great. So great. Keep coming back for interesting insights on financial and investment management themes. And happy to have you here. Thank you so much.
Thank you.
So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing. And also that registration granted by SEBI, membership of BSL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.